All right. And with all of my housekeeping notes out of the way, I am so happy to hand it over to Gibbons Miller. Gibbons, thank you so much for joining us again and for all of your time for the presentation.
Hey, of course, happy to be here. I'm going to present my screen. Go ahead and start my presentation. Okay. Nicole, can you see it?
Yes, indeed.
Okay, awesome. Hey guys, you guys are in the right place if you're here for accounting for environmental credit programs. It's a new ASU that was released last year, and there's been a couple of revisions, and comment letters were due in April of this year. We're expecting a final ASU in Q1 of 2026. So I'm going to go through that today. As you can see, it relates primarily to cap and trade programs or renewable energy credits. Hence why I have the windmills over here on the photo. Hopefully, I'm going to endeavor to give you guys some good information, and hopefully, no one no one falls asleep during the process of this presentation. I'll just give you a little bit of background on myself. My full name is George Givens Miller. I go by my middle name, Givens. I'm a CPA. I got about 12 years of experience. Right now, I'm working for Castle Biosciences. Just started that role about a week ago. Doing SEC reporting and technical accounting. Before that, I was at Marathon Oil and ConocoPhillips, focused on SEC reporting and technical accounting. I was working for Marathon Oil when we got acquired by Conoco, and then I was released as a part of a severance package or severance agreement with ConocoPhillips in September of this year. Prior to working at Marathon, I worked in public accounting at Deloitte and PwC. And a lot of the clients I served in at Deloitte and PwC were utilities and electric utilities and oil refining companies. And the interesting thing about those two industries is that they do have quite a few touch points with renewable energy credits, RINs, so renewable cap and trade programs or government issued renewable energy credits are something that impacts those two industries a lot. So I did have a little bit of experience hands-on working with some of these products when I was working in public accounting. So I might be able to share some of my experience with them. But partially what informs the reason why I'm giving this presentation today is I hope to kind of um, one show that how these might work in practice, and then and two show how this new ASU might impact the way these credits are recorded in the going forward. So let's get into the agenda. So at the very beginning, I'm just going to briefly discuss the project history from the FASB and the projected timeline for completion. So kind of already touched on that. But and then we'll get into some comment letters that were submitted and the current status of the project. We'll discuss some examples of what a renewable energy credit is or a environmental credit is, and the history of some environmental credit markets. I'll do a little bit of overview of the ASU's proposed guidance for environmental credits, an overview of the ASU's proposed guidance for environmental obligations, highlight some examples from the ASU, and then discuss disclosure, controls, and transition. So really interesting. I think for me, when I'm learning about a new accounting standard, I usually dive right into the examples because I can kind of get twisted around in the wording in the guidance. But the examples will really kind of hammer down, I guess, the concepts that are covered within the guidance above. So implementation examples will probably be at least something that I might spend a little bit more time on, just because I think that those are the most um, value added portion of the ASU. Anyway, so moving on. So here's the project timeline. In 2021, FASB Chair Rich Jones added the project to the FASB's research agenda to explore accounting for regulatory credits. So that was kind of the initial process. And then on May 25, 2022, the board added the project to the FASB's technical agenda. Lots of debate, exposure drafts, And on December 17th, 2024, the board proposed the update, and comment letters were submitted on April 15th, 2025. So they were submitted between the period on December 17th through April 15th of 25. 42 total letters were received. It included a variety of industry associations. The American Petroleum Institute submitted one, the New York Society of CPAs, the Texas Society of CPAs, groups, environmental groups like the Environmental Defense Fund. We had a few private enterprises submit comment letters. Citibank and GM, General Motors, and Ford also submitted comment letters. The Texas CPA comment letter I thought I'd just highlight here. It was written by Jeffrey Johns, CPA. It was submitted on April 3rd. I've included the link to the letter here. A few of the highlights that Jeffrey kind of talked about was he requested a little bit more information on how to adequately fair value environmental compliance credits. It could be, I've seen in the past that there's a lot of judgment involved, and so you could consider these credits to maybe fall within level 3 of the fair value hierarchy. So there's quite a bit of judgment involved. Some of these credits, depending on what the year in which they were generated, you may not have a very liquid market for these credits. So you may not be able to rely upon broker-dealer quotes or level 2 or level 1 inputs. So there might be significant judgment involved. And so I think Jeffrey appropriately kind of talked about how the board could offer a little bit more guidance on how to go about fair valuing the credits. As it stands right now, the ASU is kind of not silent, but not very descriptive. It just kicks you to 820, which is a reasonable approach. But I think given the unique nature of these credits, you might want to try to give us a little bit more. Hopefully, the board gives us a little bit more guidance on how to appropriately value them. He agreed with the presentation of the credits separate from obligations on the balance sheet. So as we'll see, basically the ASU in a nutshell kind of presents the asset, the credit, and the liability, the obligation gross. So you're not netting them. When you have a environmental obligation, you present that as a liability and you present the credit to resolve that environmental obligation as an asset. And they both represent the same value. And so you're grossing up the balance sheet. He requested 2 years for implementation, and he requested that entities not be required to estimate liabilities due at the end of the regulatory compliance period. So what that kind of means is sometimes you'll have regulatory compliance periods that don't correspond with a fiscal year end or a fiscal accounting year end. So you might have to estimate how much you expect your company will have to incur for environmental liabilities if, for example, your regulatory compliance year end is March 31st of the subsequent year. So he kind of said we should just be, required to present our estimate of the regulatory compliance liability as of the balance sheet date. So some good comments there. I also just wanted to highlight two other comment letters that I found were interesting. There was one from Citigroup, and they proposed disclosure requirements. They described the disclosure requirements as overly burdensome and will only provide limited decision useful information. So pretty harsh wording there. They had, through their comment letter, kind of advocated for the fair value technique. Naturally, because Citigroup probably makes quite a bit of money trading these products in active markets. So, in the event that they buy them, they probably recognize some kind of fair value gain while it's sitting on their books. So, and they also have the resources and the wherewithal to appropriately value these products, whereas certain entities of smaller size may not have the know-how or the resources to do it properly. So they really were excited about the fair value option, but not so excited about having to disclose all of the information required by the ASU. The Environmental Defense Fund was also pretty happy with the ASU, but they one of their critiques was the ASU, as we'll see, doesn't require actually tells entities that buy environmental credits just to satisfy some voluntary obligation. So, for example, like if at Marathon we had a sustainability report wherein we would talk about how much CO2 we were emitting, and as a sign of good faith to the market, we would purchase environmental credits from a third party to offset our CO2 emissions. And none of that was required by a government entity, so we weren't legally required to do so, but we did it as a mark of good faith, um, recognizing that oil and gas extraction is inherently um, a dirty business, and so we endeavored to try to um, reduce our environmental impact. And so the standard says that those purchases aren't allowed to be capitalized to the balance sheet. You expense them as incurred. And the Environmental Defense Fund, probably rightfully so, said that that might discourage people from voluntarily purchasing environmental credits, which would, reduce the market for these credits, and it would ultimately harm the environment in the long run. And so they advocated for allowing for the recording of the credits purchased for voluntary sustainability commitments as intangible assets subject to amortization. They also, as opposed to city, and probably because the Environmental Defense Fund's whole objective is to probably expand the use of these credits in order to continue to get corporate America to buy into sustainability and helping the environment. They advocated for the inventory model to environmental credit accounting, which would be simpler and less burdensome from a valuation perspective and also from a recording perspective. So, I think they were looking for more broad, easier to apply applications of the rule. So just some interesting kind of perspectives from those two comment letters. So okay, the current status of the project is during August 13th, 2025, the board discussed feedback received from the comment letters and then proposed the ASU and completed its on the proposed ASU and completed its redeliberations. The board's going to draft a final ASU for vote, and as I said before, it's expected to come out in Q1 of next year. Okay, so kind of already talked about this a little bit, but just kind of giving you guys a high level of what the project objectives were. They were to establish specific accounting requirements for environmental credits and environmental obligations. So the asset and the liability. There was wide diversity in practice, mainly because there wasn't definitive guidance in the accounting standards codification. And so many companies would analogize this credit that they had or this obligation that they had to other ASCs or other sections of the codification. And they mention inventory, intangibles, and contingencies. And this is expected to improve comparability and understandability of financial information. So environmental credit programs exist in several different industries. And so the hope here is that by establishing one consistent way of reporting it, you can create comparability within industry and across industry as to valuation and the obligation ultimately for environmental credits, and get some more robust disclosure on them. The guidance now provides a single source of truth, so you don't have to analogize to other existing ASCs to find out how to account for these. And as I'd mentioned earlier, at Marathon, we had these credits, and we did endeavor to try to, as best we could, interpret the guidance as it's written for these things. But obviously, we weren't able to find exact, this is an exact codification reference that would tell us how to account for them. So we use the inventory guidance and expense them as incurred. But we struggled as well to try to figure out how to appropriately account for these, given the lack of definitive guidance on the topic. So anyway, the new accounting standard, just high level overview. It creates a new topic in the accounting standards codification. So sandwich in between 815 derivatives and 820 fair value. Now we have topic 818. So it's going to be a whole new topic under the broad transactions subheader in the accounting standards codification. Um, it was created to establish the financial accounting and reporting requirements for entities that obtain and generate an environmental credit or subject to regulatory compliance programs. The interesting thing that I would highlight here, and I'll kind of reiterate these throughout the presentation, is it incorporates a few definitions that assist financial statement preparers in determining when to recognize an obligation. So one of the definitions in 818 is probable. The future event or events are likely to occur. So it kind of that definition of probable likeliness to occur will inform how we record or whether or not we record a obligation or an asset. And it will inform how we have determined that we're going to use those assets or whether or not we have an obligation. The other interesting thing here is the standard defines two separate kinds of assets, also known in the standard as environmental credits. So there's compliance and non-compliance environmental credits. Compliance, generally speaking, would be environmental credits that you know you have to remit at the end of the year to a government authority in or there's some kind of law that governs those environmental credits, and they're not really open for you to take and sell to another person or another entity. Non-compliance environmental credits would be, as the example I was talking about earlier, companies like Citibank who maybe might be speculating on the price. They don't have necessarily a compliance obligation that they have to remit these credits at the end of a regulatory period to a government agency. They're merely holding on to them as a means to facilitate transfer or sale to another entity. So those are the two kinds of classifications to think about as we're going through this. And so I just thought I'd talk a little bit about some examples of, when you might receive an environmental credit. Excuse me. So sometimes as I kind of talked about before with my work history, environmental credits can be purchased as an offset to meet voluntary environmental objectives. So a lot of companies out there have released sustainability reports, detailing how much CO2 and carbon they're releasing into the atmosphere, and greenhouse gas initiatives, things like that. And as a voluntary disclosure in those reports, lots of companies that may not be subject to either state or regional or national, cap and trade programs or legal requirements to purchase a credit for their pollution activities, they would just purchase them anyway as an act of good faith, and then disclose that in their sustainability report as a means of saying to the market that they're endeavoring to reduce their pollution footprint. A more robust, I guess, example of an environmental credit program would be the renewable energy credits in electric markets. And so renewable energy credits kind of came about. They're tradable renewable certificates. They represent 1 megawatt hour of electricity generated from a renewable source. Their history in the US is closely tied to energy deregulation and the push for cleaner energy. So energy deregulation starting in the 1970s. And so a lot of states have now pushed for renewable energy credits to be purchased by producers of power that may produce power in a not so environmentally friendly way. And producers of green energy not only produce the power that they sell onto the grid, but they also get a renewable energy credit from that power that they've sold onto the grid. And then that renewable energy credit is tradable, and it can be purchased by other producers of power who need to offset their pollution activities. A third example is renewable identification numbers. These are also tradable credits used by the EPA, but in a different industry. They're not electricity. They're used basically by gasoline and diesel refiners, and they are traded or retired. and they're generally associated with the ethanol, the blending of ethanol into refined product that comes out of a oil refinery, um, and it's to ensure compliance with the renewable fuel standard. So those are three kinds of examples. I'm sure there's more that I've left off this list, but those are three that I'm most familiar with as of today. So companies that utilize RECs, some good examples that exist in the public markets right now. Obviously, Tesla recorded a 2.8 billion in automotive regulatory credits during 2024. A good refining example, you can probably find this with all refiners, but PBF Energy in New Jersey recorded 515 million in renewable fuel credits. So those RINs I was just talking about to comply with the renewable fuel standard for the year ended December 31st, 2024. Clearway Energy, a renewable energy company, sells their self-generated renewable energy credits from renewable energy facilities. So they generate a credit from solar panels that they or solar energy, and they sell that energy into the grid, and then they receive a renewable energy credit for that renewable energy that they've generated. Excuse me. Environmental credits. So just to kind of give a high level of what an in-scope environmental credit must be, it has to be enforceable. So there has to be some kind of legal enforceable statute that requires an environmental credit to exist. It has to be separately transferable. So uh, environmental credits can be bought and sold. They're not physical and they're not a financial asset under US GAAP. Um, but they have to be intended to prevent, control, reduce, or remove emission. And it's not a tax credit. Credits can go by a number of different names. They can be called carbon offsets, carbon allowances, environmental allowances, environmental certificates, credits, etc. So they can all fall under. Generally, they can be called different things, but they all kind of fall under this nomenclature of environmental credits as defined by the FASB here. So when recognizing an environmental credit, an entity shall recognize an environmental credit as an asset if it is probable that the environmental credit will be used by the entity to settle an environmental credit obligation or transferred by the entity in an exchange transaction. So probable, meaning greater than 50% likelihood that it would be used by the entity to settle an obligation that's mandated by a government agency and or transferred by the entity in an exchange transaction, which basically means, in the event that they would sell an environmental credit that they had purchased or generated themselves in an exchange transaction. The accounting under the proposed standard is based on determinations of its expected use of the credits. So really this revolves around management's, excuse me, expected use or what management believes they're going to do with these credits. So that once you've got a credit, how you expect to use them will govern how you account for them. Compliance, exchange, or voluntary purposes can change over the life of credits, and changes in management's intent will affect the subsequent measurement of the credits. So a credit that was acquired to comply with a regulatory obligation may subsequently be traded in an exchange transaction. So in the event that that happens, the accounting around that movement from compliance to exchange there would be subsequent measurement of the credits in a fair value from a fair value perspective. So you'd go from cost recording under compliance to a fair value recording under exchange. So it would so again, management's intent will change how these things are recorded on the balance sheet and the impact they have on the P&L. Entities are prohibited from capitalizing the cost of environmental credits that will not be sold or used to settle an environmental credit obligation. So going back to what I had said earlier, this basically says that voluntary purchases of environmental credits are expensed as incurred, And if you do not intend to sell it after you've purchased it or use it to settle a government regulatory body obligation, you cannot capitalize it. So the initial measurement, getting a little bit more detail, when you initially measure an environmental credit, environmental credits that are internally generated by an entity or received through a grant shall be recorded at transaction cost. And so an example of that is many granted or internally generated credits as assets recorded. So this would result in a lot of granted or internally generated assets that are basically recorded on the balance sheet at the cost incurred to register and certify the credits with the government agency. So it'd be pretty small amount, presumably, to register these credits as to what they're recorded on the balance sheet as. Um, an entity shall determine at each reporting period date whether it is probable that an environmental credit recognized as an asset will be used to settle an environmental credit obligation. If it is probable that the environmental credit shall be classified as a compliance environmental credit and not subsequently remeasured. So this kind of introduces something that I think we talked about a little bit earlier, but the idea of compliance environmental credit versus non-compliance environmental credits. And compliance environmental credits um, were credits that were purchased to satisfy a government objective or a government mandate. Non-compliance being ones that are, set, intended to be transferred to another entity, bought or sold. Um, and so, as long as we consider it probable at the end of a reporting date that we will continue to retain environmental credits to satisfy an obligation, then we record them at cost. Continuing down this initial measurement process, all other environmental credits recognized as assets shall be classified as non-compliance environmental credits. So non-compliance and tested for impairment at each reporting date. So non-compliance environmental credits are not recorded at cost. They're recorded at fair value. An entity shall recognize an impairment loss when the carrying value of the non-compliance environmental credit exceeds its fair value. Excuse me, they are recorded at cost. Excuse me, you have the fair value option on a non-compliance environmental credit, but you would have to test for impairment in the event that you're not carrying it at fair value. The impairment loss shall be measured as the excess of the carrying value of the fair value, and similarly to other sections of U.S. GAAP, subsequent reversal of an impairment loss is prohibited. Um, so an entity, in the second paragraph here, an entity may elect an accounting policy to subsequently measure a class of eligible non-compliance environmental credits at fair value at the reporting date, with changes recognized in earnings. So similar to other US GAAP, if you elect to make that fair value election for a class of non-compliance environmental credits, the credits will continue to be measured at fair value even if the entity expects to use them to settle an environmental compliance obligation. So in the event that you've acquired non-compliance environmental credits in the expectation that you would ultimately sell them, and you would, during that time period, incurred an obligation, with the expectation that you would ultimately sell them, you measure them at fair value, and then you within that time period incurred an unexpected obligation to use those credits to offset some pollution, you would continue to fair value those credits over the life of the up until when you had decided that you were going to remit them to the government agency. So the fair value election is irrevocable, which is consistent with other US GAAP. Fair value of non-compliance environmental credits. To be eligible for fair value measurement, a non-compliance environmental credit shall be obtained either an exchange transaction or a non-reciprocal transfer that is not from a regulatory body or its designee. So a couple of examples of that. Internally generated environmental credits are not eligible for fair value measurement because they're not either designated they're not acquired in an exchange, or they're not given in a non-reciprocal transfer. Credits received through grant by a regulator or its designee are also not eligible for fair value treatment. So those two credits would be recorded at cost. So derecognition, at each reporting date, an entity shall assess whether environmental credits shall continue to be recognized as assets. If an entity determines that it's no longer probable, again, kind of going back to that management intent and what they expect to do with these credits, that an environmental credit will be used to settle an environmental credit obligation or transferred in an exchange transaction, the entity will derecognize the environmental credit through earnings. Said differently, in the event that an entity has suddenly realized that, oh, we don't really need these credits to satisfy an obligation, or we're not planning on selling them, we're going to go ahead and de-recognize them from our balance sheet. And that would be that the offset to that derecognition would run through earnings. An entity is prohibited from recognizing the environmental credit as an asset if the entity previously determined that the environmental credit was not probable of being used to settle an obligation or transferred in an exchange transaction. Said differently, an environmental credit previously derecognized or never recognized as an asset shall not subsequently be recognized as an asset. So if you voluntarily acquired an environmental credit to satisfy a voluntary cap and trade program within your company that's not mandated by a government agency, and so you never recognize the cost of that credit on your balance sheet, and suddenly years later you had an obligation due to a change in law or whatever, and you needed those credits to satisfy an obligation, you couldn't bring those credits onto your balance sheet. Their expenses incurred, and that's how they have to remain throughout the life of the credit. A few implementation examples, which I said were kind of I guess, the meat of trying to understand how to apply this appropriately. 5511 is a pretty good example of them. It's fairly straightforward, but I think it kind of gives you some some good perspective as to how to appropriately apply this rule. It gives the example of a manufacturing facility that is subject to a cap and trade program. Purchases of So the company has so they purchased 10,000 environmental allowances at $100 per allowance, and then they pay $25, 25,000 in auction fees. So normally there's some kind of transaction cost associated with these credits, and so that leaves a $1,025,000 cost of credit on their balance sheet. These allowances would not be remeasured if they continue to be classified as compliance environmental credits. So they would have that cost incurred to purchase those environmental credits at the very beginning, and that $1,025,000 would just sit there on their balance sheet until that they would be used to alleviate their obligation under their cap and trade program. And so they would be classified as compliance environmental credits. 5512, the next one is really interesting. It talks about voluntary carbon neutrality. And so in this instance, it's a software company that the FASB is using as an example. And it's not probable that the entity will use the acquired carbon offsets to settle an environmental credit obligation. Because it's a software company, they're not really generating pollution anyway. So they might be using this, as I referenced, for sustainability report or for other corporate objectives, but they don't have an offsetting obligation. And so they would expense that as incurred. And then 5513 discusses internally generated environmental credits, recognizes an asset. Internally generated credits are not eligible for the fair value measurement accounting policy election. So that example just kind of walks you through how those internally generated environmental credits are recorded at cost. Recognition of environmental credit obligations. So this is the other side. I've kind of discussed the asset side. Now this is the obligation or the liability side. So obligations must arise from existing or enacted laws, statutes, or ordinances represented to prevent, control, reduce, or remove emissions or other pollution that may be settled with environmental credits. Um, as I've kind of reiterated over and over again, I'll just say it again, an entity's commitment to achieve certain climate goals or targets is not an environmental credit obligation. So it has to be something that's written in law or an ordinance or a statute, not hey, we as a company have committed to reducing our overall emissions or achieve certain climate goals. That doesn't constitute an obligation, and you would not record a liability for an internal objective. In some jurisdictions, obligations are borne on the basis of an entity's activities and should be accrued as the activities are performed. Other programs may not require payment in the form of cash or credits until a baseline amount of emissions has been exceeded. So, as you pollute, you have to, in certain entities and certain jurisdictions, you have to remit to the government agency a certain number of credits to offset your pollution. Um, certain jurisdictions, you don't have to remit anything until you've exceeded a certain amount, you know, 100 megatons of carbon or something like that. Until you've exceeded that threshold, that floor, um, or that ceiling, you don't owe anything. And then there's other jurisdictions and certain electric markets where, as long as you're just a power producer on the grid, you have to have electricity, renewable energy credits. You have to, in effect, subsidize electricity generation from renewable sources on that grid, regardless of whether or not regardless of your amount of pollution or how much electricity you've sold into the grid. So just kind of some interesting ways of thinking about these obligations. So the recognition of environmental credit obligations, an obligation is associated with a program that requires an entity, as we kind of already talked about this a lot, to remit to a regulator a fixed number of credits as of a specified date, and so there's other obligations, as I kind of briefly touched upon, that require an entity to remit regardless of its activities. So some jurisdictions, just an entity that's existing as a business. Um, and this is kind of a unique problem with the obligation credit model is some entities at beginning on January 1, based on the business that they're in and the jurisdiction that they're in, are required December 31st to pay a minimum amount just for existing as a business to the environmental regulator. And so that presents an interesting question, which we'll go over an example of that on the next slide. But it would require an accrual and a corresponding asset that would be amortized over the reporting period. So as you're recognizing this expense that you have to pay at the end of the year, regardless of how much pollution you produce, you record an asset based on the expected amount you'd have to pay at the end of the year and an offsetting liability. And the asset represents a deferred expense and is amortized, resulting in recognition of the associated expense over the compliance period. Um, the board didn't really discuss an exact amortization method, but a systemic approach should be applied. So rational, even approach over the life of the of the asset, or so during the compliance period. So here's an example of that. For the compliance year 2024, which corresponds to calendar year 2024, so they're both the same, NTDA is required to remit to regulators 100 credits or pay a monetary fine by March 31st of the following year, regardless of its ongoing operations or its emission activities. So there's a baseline business obligation that you have to remit to regulators like 100 credits. NTDA would recognize the full ECO, environmental credit obligation, as of Jan 1, 2024, because they would recognize a corresponding asset at the same amount. They would not recognize any expense on Jan 1. Instead, between Jan 1 and December 31st, A would amortize the asset and recognize the expense ratably throughout the year. Initial measurement of environmental credit obligations. An environmental credit obligation is linked to the cost basis of the asset that will be used to settle the obligation. So this is saying that the most times the liability would reflect the same value as the asset. So the two work together. Um, Measurement of the liability depends on the intended manner of satisfying the obligation, whether the entity has credits on hand to satisfy the obligation. If the entity has a fixed volume, fixed price contract to procure credits to satisfy the obligation. So a take or pay contract that, or not a take or pay, but just a fixed volume, fixed price contract that they would buy over time at the end of the year, that they entered into at the beginning of the year, that would they would buy in increments over the course of the year to satisfy their obligation. Um, the market for required credits at the balance sheet date. So what is a fair what is the fair market value of or how is the market valuing credits that are trading as of the balance sheet date? $12 a credit, $15 a credit. That would inform how much of the obligation you would record as of that balance sheet date. So there's two types of credit obligations. There's funded and unfunded. The funded portion of an environmental credit obligation associated with environmental credits offsets the corresponding credits. So do not consider non-compliance environmental credits. So non-compliance environmental credits would be, you could think of those as ones that are intended for buying and selling. The funded portion of an obligation only relates to compliance environmental credits. Environmental credits that were never recognized as assets, so voluntary ones that were expenses incurred, can't be considered to help fund an environmental credit obligation. Environmental credits that were derecognized also could not be considered for funding an environmental credit obligation. The environmental credit obligation is measured at the same cost basis of the credits used to measure the environmental credit asset. So that gets back to that linking. An asset, the cost basis of the asset is the same as the cost basis of the obligation. The funded environmental credit would be measured after recognition and measurement of the environmental credit asset to ensure that the entity has appropriately identified the credits on hand and intends to use to settle the liability. So you measure the credit asset, and then you would offset that with a measure of the environmental credit obligation. So that kind of informs how you would think about funded environmental credits. Unfunded environmental credits are obligations that are measured at fair value of the environmental credits used to settle that portion of the liability at the reporting date. So you can have a number of different ways that you would have an unfunded credit obligation. If an entity has the intent and the ability to remit cash as opposed to getting a credit to satisfy a credit obligation, it would measure the obligation on the basis of the cash settlement amount. There's a firm commitment that exists, so you don't have the credits today, but you have a firm commitment to purchase them for a fixed quantity at a fixed price. It would measure the obligation as the cost basis of the credits to be obtained under the contract. So the obligation would simply be measured at what the fixed terms of the contract were to go out and buy those obligations. And then there would be a remaining unfunded obligation as of the balance sheet date with a fair value under ASC 820 of the credits necessary to settle that obligation. So you kind of work your way through if you have cash settlement, if you have firm commitments, and then any remaining unfunded obligation would be what it would cost to go out into the marketplace and purchase new ones. Entities are not permitted to select a fair value option in ASC 825. So you're not permitted to just fair value it from the beginning. You have to walk your way through this kind of decision tree for these unfunded environmental credit obligations. And then the remaining balances, the remaining unfunded balance, fair valued. An example of an unfunded credit obligation is when an entity receives, for example, credits with zero cost basis from a regulator. So a regulator has distributed these environmental credits to an entity. it would record the corresponding environmental credit obligation at the same amount, so zero, assuming these credits will be used mostly to satisfy the environmental credit obligation. Similarly, if an entity has a present right to receive credits from a regulator in the future that can be used to satisfy an environmental credit obligation through a firm commitment, the entity would also consider these credits when measuring the related liability. The board addressed this treatment in its January 31st meeting within the proposed ASU. The right to receive the credits must be unconditional. So if you have a right to receive credits in the future that can be used to satisfy an environmental credit obligation, the entity would also consider these credits when measuring the related liability. So just reiterating that, but that purchase cannot be conditional on some other activity. So it can't be conditional on like the completion of a plant or something like that. It has to be, you know, all you have to do is transact in the future, and these environmental credits will come to you. So that informs how you would record the unfunded portion of the environmental credit obligation. Um, Remeasurement of the liability at each balance sheet date, interim and annual. An entity shall apply the initial measurement guidance found in these references here and recognize any changes through earnings. It would be presented within the same income statement line item as the initial recognition and measurement of the environmental credit obligation. Um, Environmental credit obligations must be separate from credits. So as I've kind of said before, they require gross presentation on the balance sheet, and environmental credits that are expected to be satisfied within a 12-month period would be considered short term, and then longer than that would be considered long term. Obligations must be recognized at the reporting date based on the facts and circumstances existing at that time. So forecasting to not recognize an obligation is not permitted. So forecasting that we don't expect that we would, incur that much pollution in the future. You just have to use what you think right now, today, the way things stand, how much would we owe? So trying to reduce your obligation based on, activities you may perform in the future is not permitted. So here's a useful flow chart, I think, to kind of help you understand and walk through some of the decisions that you have to make to appropriately classify environmental credit obligations between an unfunded and a funded portion. I'm not going to walk through this, but it does kind of tell you how you can endeavor to satisfy the obligation ultimately, and how you would ultimately record it. This is found in 1830-55-1, so in the implementation section of the guidance. So there's a couple methods for satisfying an environmental obligation. So we've kind of gone through it a little bit, but you can utilize first in, first out method. So in a lot of electricity markets, there's credit obligation or environmental credits that have a vintage year. So the year in which say, for example, in PJM, Pennsylvania, New Jersey, Maryland interconnection electric market, you may have a vintage year for a specific renewable energy credit. So it may be for renewable energy produced in the year 2022, and those credits may be trading on the exchange at a cost of, $8. And so you utilize that offset. So those first in, first out. So the 2022 ones would be used first to apply to the obligation, and then you go down to the 23 ones, and then you apply that, and then 24 ones, and you apply that. You can also use cash settlement. And as I said before, the liability would be valued at its cash settlement value. So if, again, I kind of mentioned this earlier, but if their emissions are below a certain threshold, so less than a certain number of megatons, or however the regulatory body has measured it, you're not required to remit any environmental credits, and then you don't have you have no requirement to recognize a liability. If you have no regulatory compliance under existing laws, if there's no mandated cap and trade program or RINs program or renewable fuel standard program or any of that, there's no obligation that's recognized. It's just kind of reiterating stuff that we've already talked about. Um, so environmental credit obligations are not based on activities or events. Well, this is an example of an earlier example that this is just a company that just simply for existing has to pay an environmental credit obligation. So just reiterating what we've already talked about, not based on pollution or events or business activity. Um, and an entity recognized, and it's that amortization example that we had gone over before. This is another example of that because I think that might be a little bit tricky. It's a little bit of a nuance here in the guidance. It can be found at 5524, and it talks about the recognition of a credit obligation liability of 500K at Jan 1, and then a corresponding asset for that amount, and the amortization of that amount over the period, over the year. So you recognize the expense ratably over the course of the year. So getting into some disclosure requirements, entities are required to disclose the following qualitative discussion: how the environmental credits are obtained, how they're used, method for measuring, events that result in obligation liabilities, types of credits accepted by these programs, nature and timing of settlements, and how the unfunded portion of a obligation liability is measured. So those are some qualitative discussions. Here's some examples of um, the credit, so the asset discussion. There's a disclosure example included in the ASU that kind of shows you where and what types of credits companies may own as of a certain balance sheet date, and you can see how they've classified them as compliance and non-compliance. These are the assets, their location on the balance sheet, the different names of the environmental credits, um, the sales that occurred, the revenue generated, other income, where that appeared in the income statement, um, it, voluntary expenses of environmental credits. So credits that were expensed voluntarily, where those costs were recorded, the amount that were expensed, and also impairment expenses of credits. So lots of information here. And then at the bottom, a supplemental cash flow information, cash paid for environmental credits. So lots of detailed information here to walk through, giving the reader of the financial statements a lot of information about credits. Obligations, the other side, the liability side of the ledger here. Just some quantitative disclosure requirements. Another example, walking through the types, where they're located, whether they're funded or unfunded, and then the total obligation, where they're located, current or non-current liabilities, and then some expense information, remeasurement amounts. Uh, so just different, where it's hitting in the P&L. So interesting information here, kind of giving some financial statement users a little bit of background on how they're impacting both the balance sheet and where they're, income statement and balance sheet geography. Kind of go over this really quickly. Controls considerations. If the standard is issued as proposed, companies will have strong processes. We'll want to have strong processes related to establishing intent. So whatever management's intent or whatever management feels is probable, you're going to want to be able to document that pretty robustly to make sure that your intent for how you intend to use these credits, um, or how you intend to satisfy your obligation is pretty well documented. Tracking of cost, amount, and type of environmental credits. So as I kind of alluded to before, you can have credits that are different within the same reporting jurisdiction. They can also be, have different years assigned to them or different from different states. So you might want to really closely track where you acquired them from whom, and what they can be used, what kinds of obligations they can be used to offset. Um, so I think that those are some controls considerations that might come into play here. Um, Further, to kind of talk about the tracking of these credits, there's several methods for subsequently measuring environmental credits. There's the average cost, the first in, first out, which we talked about a little bit, and then specific identification. So those are three methods for tracking these credits. within a system that the ASU specifically spells out. Um, and as I said before, application of these techniques will require effective monitoring of quantities and price. The transition period for this ASU, early adoption will be permitted. So far, they haven't announced how long the transition period will be, but early adoption will be permitted for both for financial statements that have not been issued or made available for issuance. Um, and for both interim and annual periods. The proposed guidance would be applied retrospectively by making a cumulative effect adjustment to their opening balance of retained earnings. And current proposal does not provide specific guidance on cash flows. Aside from that supplemental disclosure we saw earlier with environmental credit programs. Also, worth noting that environmental credits are not considered in scope for ASC 815, so not considered derivatives. Here's some helpful resources that I think helped me when I was preparing this presentation and also kind of getting into some background of some of the things that I had done in the past. So there's a FASB kind of heads up, or excuse me, KPMG FASB proposal, tear sheet. There's the actual ASU, which you can read. It's a bit dense, about 100 pages. So the KPMG and Deloitte summary here are a little bit shorter, a lot more easily digested. The Deloitte summary is called a heads up, and I found that pretty useful when I was preparing for this. I guess I'll just go ahead and turn it over if there's any questions. I know we're kind of at time.
Thank you so much, Givens. Thank you so much again for your time, this deep dive, and all of the information in this presentation. Really appreciate it.
Of course.
And thank y'all for joining. We do have a little bit of time here for questions, but I also will be sending the slide deck with your CPE survey and certificate. And then I guess, Givens, for follow-up questions too, I can include your email if you'd like.
Yeah, that's awesome.
Absolutely. We'll do that. Does anyone have any questions? I don't want to cut anyone off if you're mid-type or if it's easier just to come off mute with a smaller group here, but I'll give a moment for questions. But if not, that is all right. If you come up with some later, you'll be able to reference the slide deck as well as thank you, Givens, for the email. You can reach out to Givens as well as we will have many more webinars coming up and other events in the coming year. So I'll hand it over to Givens if you'd like to close this out, and then I'll do my closing housekeeping notes after that.
Yeah, absolutely. Thanks, guys. I appreciate y'all joining me. Hopefully, y'all learned a little bit. It's a pretty interesting and evolving topic. So we'll see where it goes, and we'll see how the final ASU shakes out early next year.
Awesome. Thank y'all again so much. If you need anything at all, I'm only a phone call or email away, so I look forward to seeing you at the next Houston chapter event. And yes, I hope everyone has a good weekend that is maybe has a little bit more sun. So thank y'all again, and we will see you at the next event. Thank you, Givens. Thank you, everyone.
All right, bye-bye, guys.
Bye, everyone.